Hello guys and welcome back to my YouTube channel. Today's video is a continuation of my previous video which briefly focused on the inputs and outputs of a business. Today we'll delve a little bit deeper into the exact costing and the exact revenues that a firm will make in order to generate a profit. Recalling from the previous video, we have certain costs or inputs which are combined using the factors of production, land, labor, capital, entrepreneurship to produce a certain amount of output. Now, in that video, I assumed that we opened up a pizza restaurant and we use certain factors of production like land, labor, capital, entrepreneurship in order to produce the perfect pizza, which is your output. Today, we'll focus on these costs and revenues associated with the business, and we'll be able to distinguish whether a business makes a profit or a loss. On the input side, we have three equations. So the first one is total cost, which is fixed cost plus variable cost. A fixed cost is something that's fixed over a period of time, usually a year, like for example, your rent or your insurance. And a variable cost varies every so often. So for example, pizza ingredients, so cheese, the tomato base, olives, pineapples, the wages of workers, water and lights. Those are all variable costs because we're not sure how much we're going to be using in a particular month. They could increase or they could decrease depending on how many pizzas we sell. The next formula is the marginal cost. This just measures the change in total cost over the change in quantity, and average cost, which is the total cost over the quantity. On the output side, we also have three equations. We have total revenue, which measures the price times the quantity. So the amount of pizza sold times the price will give you total revenue. And then we also have marginal revenue and average revenue. The marginal revenue is the change in total revenue over the change in quantity, and average revenue is the total revenue over quantity. So if you compare these two sides, we see that there's some similarity between the marginal costs and how we work them out. Change in TC and change in TR over the change in quantity. And then AC is just your TC over Q and your AR is TR over Q. So we'll get into the detail of how we calculate these two specifically. We'll understand where the formula actually comes from using an example. Okay, so let's focus on the inputs or the costs of a business. The first one, the total cost, which is quite simple. I'll show you how to do this in an example later on when we understand what the concepts of marginal cost and average costs are. But for now, let's focus on the concept of marginal cost. Anything that's marginal in economics means the additional unit. So in this case, the marginal cost measures the increase in the total cost when one additional unit of output is produced. So let's say, for example, in our pizza restaurant, we have a certain amount of pizzas that we need to produce. The marginal cost measures the cost between, let's say, the first pizza to the second pizza to the third pizza to the fourth pizza. So the marginal cost measures the cost between number 1 and number 2, so that's marginal cost 1. Then between 2 and 3 is marginal cost 2, for example. And the marginal cost 3 would be between the fourth pizza and the third pizza. Now, the total cost, if we add up all of these marginal costs, we get to the total cost. So that's just something to understand. But the main concept here is the marginal cost. The marginal cost is the increase in the total cost when one additional unit of output is produced. So every time we produce an extra pizza, we get a certain marginal cost. And the marginal cost is measured by taking, let's say, for example, the 10th pizza and the 9th pizza, and you want to find out what the difference is between the 10th and the 9th pizza. So you'd say 10th pizza cost minus the 9th pizza cost, and then we can work out our marginal cost for that. The concept of average cost is very simple. It's just taking your full total cost of your pizza. So let's say, for example, we have a total cost of pizzas equaling 500 Rand, and we produced a quantity of 10. Then a simple calculation, and the way to calculate it would be the total cost, which is 500, over the 10, which gives us an answer of 50. So that's how we'd work out average cost. The average cost is just taking the average over the amount of pizzas that we actually produce. Okay, so to understand the marginal concept a little bit better, we need to understand this with an example. So I don't know if you ever heard the saying, too many cooks spoil the broth. That means that when we have too many workers in a small space or in a space, they sort of get in each other's way and they cause distraction, and maybe they don't produce as much. There's chit chatter between the two of them. So it's always important to keep a certain amount of people or employees and not go beyond that point. So, for example, if we start our pizza restaurant and we see that we're doing quite well and we need to hire an extra 2 people, then what those 2 extra people uh, cost us in the business will be offset by the amount of output that we produce. So, for example, if we need 2 more people, they can produce an extra 20 pizzas a month, which will increase our output and increase our profit level. So that's a good hire. But now let's say, for example, we get greedy and we get excited that these 2 workers are producing 20 extra pizzas and we're seeing such a great increase in output. We hire an extra 3 people to make more pizzas. Or even hiring just 1 more would cause a little bit of distraction or a little bit of chaos in the kitchen. That means that our marginal cost now will start rising because the increase in the pizzas that we're producing doesn't really have the desired effect on output. So there's a sweet spot that we need to try and employ a certain amount of people. And if we go beyond that point, we're going to start increasing our marginal cost. So our marginal cost does something like this. As we hire more people that we need and not going beyond that point, our marginal cost will decrease. So let's say it decreases up until 8 workers. Now, for example, we get carried away and we want to employ more people because our business is doing well. But we don't really understand that if we employ an extra person, it's going to cause a little bit of chaos in the kitchen. And people might start talking to each other and not actually working. And that will decrease the output that we're actually producing and increase the cost. So marginal cost now after this point 8, so number of workers, which would be 8, will start increasing. So our cost will start doing that. So this curve here represents an initial decrease in costs when we hire more people because they're producing more output. But then as we employ more than the required amount of workers that we actually need, our costs per worker or cost per output product produced will start increasing. At the same time, if we look below, we have a second graph, which is our total cost and total number of workers on the right-hand side. What will happen as our marginal cost increases, obviously our total cost will start doing that. So we have a total cost line or a curve, and we have a marginal cost curve as well that looks like that. Our average costs, on the other hand, we need an example of this. So when we do the table, we'll be able to understand how the average cost looks like, and it would look something like this. So if we had this, it would look something like that, which is a similar shape to the marginal cost. Obviously, I haven't drawn this in the best way, but you get the idea of the graphs first decreasing both sides, and then it will start increasing for both curves as well. Moving on to the concept of output, we have our first one, which is total revenue, price times quantity. We'll also understand this with the table in the example, but we can move on to marginal revenue. So marginal revenue, just like marginal cost, is also the additional unit of increasing, measuring either in terms of production or revenue. So for example, here we have our pizza. So we're producing 1, 2, 3, 4 pizzas, and we as the, let's say your entrepreneur or the boss or the owner of the firm or the restaurant, we want to find out what's our marginal revenue per pizza. So every time we produce an extra pizza, so you see the 1 unit increase in the pizza production, we want to find out what's our revenue amount. So we look at the difference between the first and the second pizza. So here we got something called marginal revenue 1, and then the difference between the third and the second pizza is marginal revenue 2, and the difference between the fourth and the third pizza is marginal revenue 3. Now, if you add all of those up, you get something called your total revenue, which we'll discuss as well later on in the video. But for now, it's important to understand that the marginal revenue basically measures the difference in the revenue per unit every time you produce an additional unit of pizza. So again, just like all marginal concepts are the same, this just now focuses on the revenue instead of the cost, like we did in the previous slide where we talked about marginal cost. This deals with marginal revenue. The same thing with average revenue. Average revenue just takes the total revenue, so the amount of revenue produced, for example, over 100 pizzas, we take the total revenue divided by the quantity. So for example, if we return a revenue of 1,000 Rand divided by 10, the amount of pizzas that we sold, 1,000 divided by 10 gives you 100. So our average revenue will equal to 100. Before we delve into the graphs, some textbooks use total product, so TP instead of TR, MP instead of MR, and AP instead of AR. One and the same thing. What it means is that one is calculating the total product and using TP to calculate it. Other one is using TR to calculate exactly the same thing. So if they use that MR or MP, it's basically one and the same thing, which measures the amount of output that's been produced. And one looks at it in terms of the products that produced to calculate the revenue, and one looks at it just classifying it as revenue from the beginning. So here, for example, we have our graph of marginal revenue and the number of workers. Let's say in our pizza restaurant, we identify that we need a certain amount more output, so we hire more people. So they come with their associated costs, and we want to find out what's their revenue like per product of production. So let's say we employ extra people. Maybe we need an extra person at the front, so at the cashiers, or we need an extra chef at the back to produce those pizzas. So that will increase our productivity as well as our deliverability to meet the demand of consumers. So it will be good for us. So what happens to our marginal revenue initially is it will go up until, let's say, 8 workers. But now we mismanage or we get greedy again and we employ more people. And with those extra people, we get extra costs. And too many cooks spoil the broth again, causing a decrease in the revenue that we're actually producing. So if we use this with marginal cost, then we'll see that our marginal revenue starts to decline because we employ too many people. So again, there's a sweet spot to employing a certain amount of people. And if we go beyond that point, then we're going to start seeing a decrease in total or marginal revenue, and then also on total revenue. Now, total revenue also increases by the amount of workers that we have. So we have an increase in total revenue up until a certain point, and then it starts decreasing, calling this total revenue or total product, and this is marginal revenue or marginal product. So both times after 8 workers, we see a decline in our total product or total productivity. This is actually known as our total product curve. So maybe we can just keep that classification as total product. So the amount of products that we're actually producing. So if you look here, initially, what happens is our marginal revenue increases because we employ the amount of people that we actually need. So they're producing a good output. But as soon as we go beyond that point of increasing by too much, then obviously we start seeing a decline in marginal product or marginal productivity of workers. The same thing happens here. We have an increase in total product, so total productivity, but then after a certain amount of people that we hire, we see that there's a decline in total productivity because now maybe they start talking again and they're not focused on their work in producing product. The customers are waiting, keeping them waiting, and then we see a decline in our business because obviously we have chaos in the kitchen. The concept of average product or average revenue will do the same thing as your average cost, but what happens now is we get something that looks like this. So that would be your average product or average revenue, um, which also takes into account your total cost or total product in this case divided by your quantity. And you'll see this how we can draw this and show it on the graph using an example. So if we had to look at the two graphs together, with regard to our marginal cost and marginal product, which obviously our marginal cost is our input, that's our cost of the business, and this represents our output. Let's say, for example, we have a sweet spot of 8. So our marginal cost initially will decrease up until a certain point because we're hiring the right amount of people. And together with that, our output will also increase to a certain point. And then when we go beyond that point of hiring too many people or too many workers, then our marginal cost will start increasing and our marginal product or revenue will start decreasing. So that represents our marginal cost and that represents our marginal product. Now, another important concept in economics, which I didn't mention earlier, is the law of diminishing marginal returns or marginal product. Basically states that as we increase the number of workers and we increase the output, there's only up until a certain point that we can go. And after that, what happens is as we add more workers, so we go to the 9th worker, to the 10th worker, our revenue or productivity starts decreasing. And this basically represents the law of diminishing returns. So the important concept here is your marginal concepts, which measure the change in an additional unit of either production, so the costs associated, so you got marginal cost, and the marginal product, which is the amount of output that you're actually selling. The marginal concepts measure those additional units of either costs or production in the form of output. And that's the most important thing to understand in this video, to understand that when marginal costs are decreasing because we're employing the right amount of staff and they're producing the right amount of output, so our marginal product will increase. And then as we employ more than we need to the 9th and the 10th worker, our costs start increasing because we have to pay those people, and our associated marginal product will start decreasing. So we can see here that the exact opposites of each other, and the understanding is using the concept where you rely on one of them. So if your marginal cost is decreasing, that means your marginal product is increasing, and if your marginal cost is increasing, then your marginal product is decreasing. These are the concepts that we'll focus on using an example and figures in the table to understand the concepts that we've learned today. So we had our total cost, marginal cost, average cost, and then on the output side, we had total product or total revenue, marginal revenue or marginal product, average revenue or average product. And we can combine these using a table, and then we'll be able to understand our different formulas that we use for each one of them. And that will make it a lot easier for you to understand the costs associated with a particular business, in our example with the pizza restaurant.